Are you chasing yield? High yield is always what people look at, always talk about those big numbers. Let's explain if this is good or bad. Welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And this is a topic that's come up through quite a different conversations that we get a part of, is that people talk about high yield. They're always talking about the yield. I can get 14%, I can get 12%, I can get 20%, I can get 80%. Question is, are you chasing yield? And what does it mean to chase yield? We're going to cover all of that today. But before we do, we got to do a shout out to all of our Patreon supporters and all our YouTube members. Thank you so much for supporting the channel. If you're not part of the family, don't be afraid. Hit that subscribe button, hit that bell notification. Don't be afraid to join. All we're trying to do is help you grow your portfolio. Let's get into today's video. First, we have to talk about a disclaimer. Past performances do not guarantee future results. The information provided in this video is for educational and informational purposes only. It should not be considered financial advice. If you need financial advice, always contact a professional. So I did a little survey. What is the best curtain to open? I did this survey with 100 of our Patreon supporters. And I said, if you have a choice between 3 different funds, and one yields 13.38, one yields at 8.41, and one does 8.57. Which is the best curtain to open with this information? And I was shocked at what we got back from the survey. And I'm going to let you guys play the same game during this video. Which yield would you pick? The 13.38, the 8.41, or the 8.57? I'll give you a second to think about it, and then we'll show you the actual answers that we came up with from our survey. The first one, picked by over 50% of our survey people, and that fund was QYLD. This one has the 13.38% annual yield. Now, QYLD is from Global X. It does the NASDAQ 100 covered calls, holds the stocks in NASDAQ 100, sells covered options on these strategies. Now, they have over $8.14 billion in net assets. But when we take a look at the performance over 1 year, they had a price decline of 4.21%. It had the highest yield at 13.38%, but it actually has a total return of 9.17%. So what it basically told us is that while providing significant income, the strategy caps the upside growth, leading to a notable decline in the underlying share price over time. Now, the next one that was picked, and that was the JEPI, the balanced performer. 30% of the survey picked this one. I have my personal opinions on it because I think people are thinking we're trying to set them up, and that would be the lowest possible one would be the greatest. Well, it didn't turn out that way. JEPI is the JP Morgan Equity Premium Income ETF. It aims for a balanced income generation and capital appreciation. Now, here's the neat thing about this. This uses equity-linked notes, ELNs, combined with covered calls. It's a broad sector diversification across all the large cap U.S. stocks. It does have the lowest expense ratio, but when we take a look at what JEPI has done, and that is they had a 4.55% price decrease, a yield of 8.41%, for a total return of 3.86%. So it actually has a very low total return because of those price decreases over the past year. And now, of course, 20% of the people were left, and they picked the QQQH fund with the 8.57% dividend yield. This actually turned out to be the right choice. QQQH is NEOS's NASDAQ 100 Hedge Equity Income ETF. It invests in the Nasdaq 100 stocks while purchasing protective put options on the index. So this maintains the exposure of the tech-heavy growth, purchases the protective put options to migrate any losses, and aims to preserve the capital during volatile periods. So when we went deeper into this one, we said, wow, you had a price increase of 3.82%, a dividend of 8.57%, for a total return of 12.39%. So effectively, what did we run into? Well, QYLD with the highest yield netted us a 9.7 total return. JPEI had a lowest yield and generated us only 3.86% total return. And QQQH with that protective put options had that 8.57 annual distribution, but gave us a 12.39% total return. So the real reason for what we did, or what I did here, was to give you this answer. Total return is the real number to be looking at, not just yield, but look at total return numbers. So if you look at a fund's total return, which is basically a simple math of your distribution yield minus your NAV or growth, however you want to put that, performance over the past year. So as you can see that we've done, and that made QQQH the total winner. So total return is what we want to look at. So now what I did is took the total return comparison. So let's just say if you're like me in retirement, you're going to spend your dividends. So you have $500,000 that you have invested in these funds, and you need $40,000 to live off of. So when we first take a look at it, JEPI generated enough income to live off of. But the fund's value dropped by the $22,750, which means you would have $479,300 in your fund's value. But if you would have invested in QQQH, which of course had the middle of the road income but had the total return highest number, you would have $42,850 of income, which covered your $40,000. You would have $19,100 of additional growth, which means your fund would have ended up with $521,950. And then QYLD, which had the highest total return or total yield, you would have generated $66,900, which is $26,000 more than what you actually needed. But your fund dropped $21,050. But you would have grown your fund by $5,850, even with spending your $40,000 of cost of living. So realistically, QQQH emerged as the winner with the highest total value, but QYLD's increase in income helped offset the fund's value. This is why, again, total return is so critical, that you can understand what it does to a fund. Now, we did one more thing. If maybe you're not in retirement, maybe you're not into me that you care about that return on an investment. So what you want to do is you're going to reinvest your dividends. So we looked at it this way. And basically the values went up $40,000. JEPI grew by $19,300. QQQH went to $561,950, and QYLD went to $545,850, reinvesting those dividends. So again, QQQH wins the game, but QYLD is catching up very well because of the large income versus total returns. So basically, everything comes down to phase-based investment strategy. Where are you at on the timeline? If you're at a point where you're accumulating growth, like 20 years out from being retired, you're going to look for what you can get for largest total return. You're looking how to get long-term growth, and you're going to have multiplying down the road. If you may be in transition, you may be in that five year or maybe a little earlier that you're starting to make that transition, that you still need growth, but you're starting to evaluate that you're going to need some income. Or if you're like me in the distribution, you're already in retirement and you're living off your portfolio, then you're looking at income. So I really put it as accumulation is growth. You need all growth. For almost literally forget about income. When you start transitioning, you're starting to transition to growth with some income. And then in distribution or retirement phase, you want all income and very little growth for inflation. So realistically, phase one, the accumulation, as I said, you want growth. Then phase two, you need a balanced mix. And then three, you want to live off your portfolio. So our key takeaways and lessons that hopefully you learned from today: total return is king. Chasing yield does not guarantee the greatest wealth. You can see that in QYLD. QYLD's capital depreciation resulted in a lower total return. And the balanced approach like QQQH led to a better long-term wealth builder. So just remember, total return is better and what you want over just pure yield. Now, phase-based strategy, you want to match your ETFs to your investment timeline and goals. Now, again, this is not financial information. This is just what I call common sense investing. This is what you want to base it off of, but always talk to a financial advisor. Consider your risk tolerances and your income needs. No universal best ETF choice depends on circumstances. So again, you're not going to find one fund that fits everything you want, because if it was, everybody would be in it and we wouldn't have a stock market like we do. So you always want to align yourself with what your goals are, what your strategies are, and how does it fit you personally. So the phase-based ETFs, the accumulation, QQQH gave you the best of both with that protection, gave you some growth and gave you some income. JEPI gave you gave you income. It's a balanced approach. Unfortunately, this year they're off. And distributions, QYLD gave you the highest income, but it didn't give you the highest results. And again, I just tell you, no single ETF is universally the best based on your unique situation. That's why I hold 5, 6, 7 different ETFs in the portfolio to be able to live off of. I hope this information was helpful to you. I really appreciate you, and don't be afraid. Leave some comments down below. Love to hear what you guys think about total return versus chasing yield. It helps everybody on the channel.